Every day, independent oil and natural gas producers are out there drilling smarter, going farther, and delivering the energy that fuels our economy and strengthens our national security. It's a side of the industry that's dynamic and foundational to how affordable, reliable energy gets made in America. This podcast is about diving into that world. We're talking tech, policy, production, and pressure points. Everything that shapes how American energy actually works. This is Longer Laterals. Welcome back to Longer Laterals, a podcast where America's energy story meets Washington. Today, I'm thrilled to be joined by Kaes Van't Hoff, CEO of Diamondback Energy. Diamondback Energy is one of the country's largest oil producers and the largest pure-play Permian producer. A remarkable growth story for a company that didn't exist 20 years ago. Kaes has had a front row seat to Diamondback's growth story. Since formally joining the company in 2016, he's held leadership roles across strategy, corporate development, finance, and business development before becoming CEO in 2025. Prior to joining Diamondback, Kaes lived on the East Coast and worked in finance and investment banking. And before all of that, he grew up on the West Coast in Southern California, where he graduated from USC and had a stint as a professional tennis player. So one of the more interesting career paths in our industry. We're super excited to have Kaes today and hear his unique perspective, especially at this critical moment in time for American energy. Welcome, Kaes.
Thanks for having me, Anne. It's a pleasure to be here.
Let's maybe start diving in a little bit to your story, and then we'll talk a little bit about the industry, and then we'll turn to current events. So first, your path to the oil and gas industry has really been a fascinating one and a very unique one. Growing up in Southern California, making your way to New York, and then ultimately landing in lovely Midland, Texas. Can you talk a little bit about what attracted you to the oil and gas business and how Diamondback has evolved over your time with the company?
Yeah, it's an interesting story. I was very fortunate to end up where I am today, but the path to that, to where we are was, not something anybody, in my family or myself expected growing up, right? I mean, I grew up in Newport Beach, California, surfing every day, and didn't have any idea what the oil or energy complex looked like. Probably didn't even know the price of oil. I guess I knew the gasoline price because they get pretty expensive out there in California. But my path was really towards a world where I kept my options open as a young kid, and moved to New York after playing a little bit of pro tennis. I think I realized that wasn't going to be the profession that was going to pay the bills long term, but I had a really good time. And then went to New York to go to a place where I didn't think any doors would be closed, by moving there. And that was exactly the case. And, a couple of years in banking led me to a place called Wexford Capital. And Wexford happened to be the private equity firm that backed Diamondback. And so got Diamondback started. The story of Diamondback is one of the, kind of the poster child for shale growth. We were a company that I was like the little analyst on the IPO from Wexford. I didn't know anything about oil and gas, didn't know what a type curve was, but I knew how to model. And so I would come down to Midland and build the operating model and then, learn the business from a guy named Travis Stice, who was our CEO before me. And, that little company went public in 2012 at 2,000 barrels a day of production. And really, we were a company that nobody wanted to buy. We actually tried to sell the company before going public, and we went to 8 bidders and got 0 bids. And, we were forced to go public and forced to build this culture of, acquire and exploit in the Permian Basin. And it just kind of happened to coincide with the advent of, shale oil and the shale oil revolution. And it's been quite the ride. I started full time with Travis in 2016. So from 2012 to 2016, I ran a drilling company, and then got here, and it's been a wild ride. We started at when I joined in middle of 16, we were about a $5 billion company, and now here we are, obviously with some oil price help recently to get to a $60 billion market cap and a $80 billion enterprise. So the ride is just beginning, but I think it's going to be hard for us to replicate the 300x growth in production that we've done over the first 10 years as a public company.
I would imagine so, but it's been a lot of fun to watch from my perspective. So very, very cool story. Zooming out a little bit, the U.S. EIA recently announced that U.S. energy production reached another all-time high last year, averaging 13.5 million barrels of crude a day, meaning that America now produces more oil than any country in history and will likely hit another new record again this year. And a lot of that growth has been really driven by the Permian Basin and really the Texas side of the Permian Basin where, y'all operate. Can you talk a little bit about what has made this possible, both from an industry perspective and an operational perspective, but also from a public policy perspective?
Yeah, I mean, I'll kind of lead with the industry, and if you think, it starts with the rock, right? This is some of the best resource in the world, and but it's the best resource in the world that can be executed in, the most geopolitically safe, regulatory certainty, basin in the world as well. So the combination of, access to services, regulatory certainty, ability to build infrastructure, and we move a barrel of oil from Midland down to the Gulf Coast. It costs, $1.20 a barrel. I mean that kind of infrastructure is second to none, and it's because of the size and scale of the basin that's able to happen. And I think I always say never underestimate the American engineer, because we've always tried to just continue to do a little bit better on our business every year, and the efficiencies and the longer laterals
Hmm.
that we've all been drilling, longer and longer and longer versus where we were 10 years ago. I mean, 10 years ago a 5,000-foot lateral well took us 25, 30 days. Well, now we're drilling 15,000-foot lateral wells in sub 6 days. It's truly impressive. And we didn't get there in one day, right? We didn't get from 30 days to 6 days overnight. It was a lot of little wins and a lot of engineering. And I think there's still room to go, but I think on the other side of this, I think industry wide, we're really only recovering 10% of the oil in place in the basin today. So we're leaving 90% of it behind. And I think the next wave of the shale revolution, which is going to keep this, 13.5 million barrels a day going, or grow it in the future, depending on price, is, kind of a technological wave subsurface that I think is, it's in its infancy, but it's coming our way. So I'm pretty excited about what the future holds. But again, from a regulatory and policy support perspective, allowing us to keep doing what we're doing, giving us regulatory certainty to make these big long-term capital allocation decisions. Those are keys to keeping this business going.
So let's drill down, no pun intended, on that a little bit more. So, a lot of America's energy basins are maturing, yet producers are continuing to find ways to increase productivity. Even as rig counts went down last year, production went up and set a new record next year. So, can you talk a little bit about the innovations that are behind that increase in efficiency and the innovations, and how much more runway do you think there is?
Yeah, so I kind of hit the above ground efficiencies, right? How fast can a drilling rig drill? How far can the lateral go? Anytime we don't have to go vertical, we save money, right? By going on longer on the laterals, trying to hit the podcast title here. But it
Appreciate
really
that.
does make your efficiency that much better, right? If you go from 2 miles to 3 miles and now some 4 mile laterals, we save about $1.5 million not having to drill that vertical section. So now it's about doing that more and more consistently. Let's say the best well is 5 days, but we drill 500 wells a year and the average is 9. Well, I want to get our average down to 5. And so that's what's happening on the drilling side. On the completion side, on the frac side, we've really continued to one, complete more lateral feet per day, but we're doing it with more horsepower and a better efficiency of delivering the frac to the rock. So we think we're getting better. We call it stimulated rock volume, but we're cracking rock more efficiently and faster, and that's I think is what's getting us better wells on average. And that's going to be a fight, right? Geologic time is undefeated. We're naturally going to be drilling lower quality inventory over time, but if we can keep finding ways to reduce cost or improve improve recoveries, we can fight that geologic fight for a long time. And so I think all that married with this technology suite, we can call it AI, we can call it machine learning. I think there's just a lot of good things coming our way for this basin and for the U.S.
That's really exciting. Let's talk a little bit more about the rock and the drilling process a bit. So, the foundation of America's energy revolution is drilling in this very hard to reach shale. Shale wells produce a significant amount of oil and natural gas in year one, and then experience a decline in production known as a decline curve, but do continue to produce for years, even decades to come from there. But as you look at that decline curve and what it takes to maintain or grow production, how does that reality shape how you allocate capital when you're thinking about either sustaining output or growing output?
Yeah, I mean, you need to think about the long term, right? And so you need to allocate capital the right way for the resource to be developed most efficiently. And so, you know, look at Diamondback. We produce 500,000 barrels of oil a day net, 600,000 gross. We have to replace almost 40% of that every year just to hold our production flat. And so that's about, 500, a little over 500 wells a year just to stay flat. To grow, we have to accelerate beyond that. So, I think there's a couple things. There's a lot of time and money now being spent on our decline rate, right? Forever, our business was so focused on CapEx and the capital side of the business that OpEx, it's always been important, but it's becoming a much bigger piece of the pie. And if we can just continue to reduce that decline rate, maybe just by 1% a year, even 2% would be a huge win. But if we can lower that decline rate, we need less capital to stay flat. Then we have more optionality to either grow or stay flat with a lower sustaining capital number. And that all ties to inventory duration and how much inventory you have and how long you're able to do it, right? In the public markets, that's what's driving valuations, right? The bigger companies with more inventory and inventory duration tend to trade better because investors know that you can keep that capital efficiency going for a longer period of time. So it's our job on our side to, you know, one, maintain the capital efficiency or try to improve it, and two, try to extend that duration, which we've done through a lot of deals, right? We're not what's called a white space exploration company. We're more of an acquire and exploit company that's done a lot of M&A transactions to get to where we are today.
Okay, let's shift a moment to sort of present day, which I think everyone is very interested in. So
There's a
we
little
are
bit going on right now.
there's a little bit going on. We are more than 2 months into the largest energy disruption in modern history. Help us to separate the signal from the noise and look beyond the headlines a little bit. What are you seeing in terms of the current disruption in energy markets, and how do you think this? How do you think about this in terms of short-term volatility versus longer-term supply and demand fundamental, like structural change?
Yeah, so let's walk back to January 6th of this year. We had the incident in Venezuela, and everyone going into 2026 was thinking that this was going to be a bad year for the oil market because there was a perceived oversupply. We can debate whether that was 1 million barrels a day, 2 million barrels a day. Some people had higher numbers, but let's just say we were between 1 million and 2 million barrels a day of oversupply. In our market, that's a big number. It's about 105 million barrel a day market. 1 million barrels a day doesn't seem like a lot, but it actually has a huge impact on price. And so we came into the year thinking, hey, this is like, let's just get through the first half of the year, maintain our oil production, generate free cash, return that cash to shareholders, and and live to fight another day. Because as you know, in this business, the cycle always turns, and there's probably a world where 2027 and beyond started to look pretty good from a global balances perspective. Now, what happened was, obviously the incident in the Middle East and the closure of the Strait of Hormuz has resulted in a significant amount of production being shut in, and I'm trying to separate the geopolitics from just the supply demand dynamics, and to me, the supply demand dynamics is every day that strait is closed, somewhere between, call it 9 to 11 million barrels a day of crude is not moving to end markets. And I think over 60 days, that's enough to tell you that the market needs barrels to come and do whatever you can to replace, what's going on here. I mean, I kind of liken it, and to like inverse COVID, right? COVID, at the bottom of COVID, global oil demand was down somewhere around 20 million barrels a day. This is near the same type of issue on the supply side.
Mm.
And I think, the market's a little bit complacent about it. I think the overall market's a little bit complacent about it because oil's become a smaller part of GDP. But you and I both know that the knock-on effects of what's happening here are going to take a long time to sort out. And so for me and for Diamondback, we made the decision in Q1 earnings to start to grow production a little bit, 3% or so, which is a drop in the bucket compared to the problems that we're facing. But I know that the near-term signal is pretty clear, but also with the amount of barrels that are being released from, strategic petroleum reserves around the world, those barrels are going to need to get bought back for countries to think about energy security, 2 to 5 years from now. And so I think that generally puts a bid under oil. I always joke, and if I wasn't long-term bullish, I'd be out of a job. But, I do think, the amount of barrels that are being released from these strategic reserves are going to have to get rebuilt, even if demand hangs in there globally. So, we've got kind of a mess on our hands here in the oil market. I'm very fortunate. We're very fortunate, Diamondback, to just be in West Texas, not dealing with safety incidents like some of our other members who have international operations. But we're going to do our little part and add some barrels to the market. And if the market changes, we will react accordingly, like we always have.
So one of the things I heard you say is that, countries are going to be really reevaluating their energy security after this, especially after the release of the SPR, and, looking at, what does being energy secure mean. I'm also curious at how you think the world might be viewing American barrels differently today, because I've heard a lot about sort of they seem to be they are the most in demand barrel in the world right now, and sort of what's the advantage for the American producer given what's going on in the world right now.
Yeah, I mean, I do think an American barrel is certainly advantage. I would have told you it was advantage before, but that's my job. But it goes back to that comment on best regulatory environment, best geopolitical environment, best access to services and midstream and infrastructure, and that all allows these barrels to flow freely onto the global market. I mean, we are now exporting almost double the amount of oil that we were exporting prior. And, it's a testament to the system that we have in place, right? The amount of storage and the amount of takeaway capacity down on the Gulf Coast. But it's also because, our allies and countries around the world are desperate for, barrels in a markets that's starved of them today. So we can't do this forever, right? The math doesn't math at some point, but we are overly supplying the rest of the world right now with U.S. barrels and U.S. LNG on the gas side, right? We've had a huge wave of development and growth on the LNG side. We don't do as much on our side, but it certainly helps clear a market that produces a lot of gas. And then, and if you take it back to the economy, right, that insulates our economy a little more than others around the world. We are, a net exporter of oil. In the GDP calculation, net exports is important. Well, just think if we were back where we were 2010, 2011, still importing 6, 8 million barrels a day at $100 a barrel. This industry and what we've all done on the oil and the gas side has been a huge tailwind for this economy.
Absolutely. Our economy would likely be crippled right now if it was not for the shale revolution and what y'all have brought to market.
Yeah, listen, we're not running a charity, but I know our industry likes to pat ourselves on the back, but it is pretty amazing that the U.S. went from one of the largest importers in the world to now one of the largest exporters, producing the most amount of oil per day of anywhere in history in like 12 years. It's pretty incredible.
Absolutely. So you're bullish on demand, both globally and domestically. Talk a little bit about how important is it for operators like you to operate in a durable policy environment? You talked a little bit about what goes into capital allocation decisions and sort of that longer term time horizon for, first how much capital it takes just to sustain production and how hard it is to increase production. So, what happens to American energy security if the policy pendulum swings sharply back and forth every 4 years?
Yeah, it's hard. It's hard to make decisions. I mean, we'll go back to some decisions we made in 2016, which was a long time ago. But there was an election that year, and the Democratic candidate was very against permitting and potentially permitting on federal lands. And at the time, New Mexico was going through a big growth spurt, and but they had a lot of federal lands. And so Diamondback, we made the decision to not move into New Mexico because of that regulatory uncertainty. Now, turns out that was a mistake, right? New Mexico's continue to figure it out and grow. But those are the conversations that go on in boardrooms, of all the producers. What happens if it swings this way back? It goes back to that regulatory certainty discussion. And I think if I'm trying to appeal to the other side, keep it in the ground is not going to work. I mean, we need to produce barrels. We need to feed this economy, and why not? Why not? Because if not, someone else is going to do it, right, around the world. So why not support the most, regulatory certain, geopolitically safe? The dividends that we pay out go to Americans' 401ks and don't fund MiG 29s. Let's support local. And we also do it with, in my mind, the best environmental footprint in the world, because our investors, our public investors, hold us to higher standards than regulators. And so all that to me is like, let's have a rational conversation about who's producing the most economic, environmentally friendly, geopolitically safe barrel. And that, in my mind, that's a Permian Basin oil producer, or a Northeast gas producer on the gas side. And we can do this for a long time.
So let's pick up on that natural gas point and talk a little bit about Permian natural gas. So we've mostly been talking about oil, because in the Permian, that's the primary product that you're drilling for. But the
Not
Permian
what we
also
make money on right now, yeah, that's for sure.
that's what I'm getting to. So you also produce a lot of associated natural gas. And last time I checked, which was last week, so this might not be the most up-to-date statistic, but the natural gas price at Waha, which is the main natural gas trading point for the Permian, was around negative $10, meaning it is costing you money to produce natural gas at a moment when natural gas has never been more in demand, both at home and abroad. Can you talk a little bit about that dynamic, how that impacts your business, and what it might take to fix that?
Yeah, I mean, I would say, if you think about our business and how we've modeled growth at like Diamondback or in the basin for the last 10 years, you know, oil has outperformed expectations a little bit, but gas has outperformed expectations by a material amount, right? And so
In
we,
terms of
in
production.
terms of production growth,
Okay.
so
Yep.
the two things we always underestimate are natural gas production and water production in this basin. Oil, we're pretty good. We kind of have a pretty good idea where our oil production is going to be, but the gas production just continues to grow. And I think there's a couple reasons for that. One, we all drill our oiliest stuff first because it does drive the economics. You do have operators going to more gassy zones throughout the basin. There's even new zones like the Barnett, the Woodford, that are going to be even gassier. And so I kind of joke, and it kind of scares me that this basin hasn't even tried to produce gas yet. But what scares me on the infrastructure side now, what's finally happened is that we've had a lot of consolidation. So operators have moved into our, like, we're a much larger operator than we were 6 7 years ago. Well, we feel comfortable signing up for more and more capacity on new gas pipelines to get them built. And so you have two new pipelines coming online this year that should help alleviate some of the problem for a period of time. But behind that, for the first time, I can see that there's 6 years worth of pipelines in the queue that are going to get built. And it used to be, I don't know, a little song and dance between the operators and the midstream companies. The operators wouldn't commit enough, and so the midstream people wouldn't, the companies wouldn't build. I think we've kind of found a little balance there, particularly with kind of the wave of LNG on the Texas Gulf Coast now, that there is a big demand pull, for our products. And I think we'll see positive gas prices for a period of time, but don't underestimate this gas curve out here. It always outperforms expectation.
Yeah, negative 10's a lot.
Negative 10's a lot. I mean, if you do the math, if you're really at negative 10 and you're not hedged, you're shutting in oil production. And so, it's very hard to convince yourself to shut in an oil well at $100 oil, but at minus 10, you start to lose money on your NGLs, your heavies, and you're eating into your oil revenue. So there are certainly wells around this basin that are shut in at these prices.
Which is alarming given everything that's going on in the world. But and it's good to hear that, there is new infrastructure coming in the coming months. So
Yeah.
that's
So I mean,
exciting.
this is another few months until pipeline one comes on, and then another few months until pipeline two. But again, I think as an industry, you know, we're going to keep supporting all the new pipes, but then also I think there's probably a huge, I'm a big believer in the power wave that this country is going to see, and I think there's going to be a lot of power deals done in this basin, given where gas prices are and how much power we can provide to the state of Texas, but also these hyperscalers that are now coming around talking to us.
Absolutely. Lot of opportunity there. Um, let's talk a little bit about Midland, city that is near and dear to my heart, and I know your current hometown. But one of the things you really see when you go to Midland is that no other city I visited is really as steeped in that history of boom and bust cycles that has characterized much of the oil production sort of history as Midland, Texas. What would you say industry has learned from these past boom and bust cycles? And what do you think those learnings mean for the long-term health of the upstream sector and more importantly for the workforce?
Yeah, I mean, Midland is truly unique. I mean, and everybody's also, in it for the same reason, right? We're all basically in the same industry, or if you're working in Midland or starting restaurants, you're highly dependent upon the oil price and the oil business to be doing well. I think just before my time, but in 1982, Midland had the largest Rolls-Royce dealership in the country. That was kind of the old days of Midland Cowboys spending all their money.
Yeah.
And I think the industry, just like anybody, the industry's learned and evolved, and also had a lot of consolidation, right? So the companies that operate in this basin are now so much stronger. We don't spend every dollar that we make, trying to drill new wells. The resource is pretty well known. Capital discipline, which kind of came out of COVID, which was a near extinction level event for our industry and for companies like us. I mean, that was a scary time, right? We ran a model that said how long can we wait to drill another well before we go out of business? And that was certainly an eye-opening experience. The companies though are just stronger than ever, and we're still generating, obviously at these prices, a ton of free cash flow. But even look at a year like last year where oil was 60 or below most of the year, companies still generated free cash flow. They paid their dividends, they bought back shares, and I think that's a testament to where this industry has come. Now, there's still the crazy wildcatter in Midland that's going to go boom and bust every cycle, no matter what. But I would say the vast majority of production and companies are in really really good shape.
Yeah. You're also struck, at least when I go to Midland, by the level of community investment that companies make, even in not great years, in the community and the roads and the schools and the parks and ballparks, and it's really heartening.
Well, and I think the strength of the companies allows the city to invest through the cycle, because through all the early boom busts of this, called the Shale Revolution, we'd get some traction on trying to build something here, and then oil price would fall out of bed, and then the project gets canceled. Larger, stronger, more companies based here supporting through the cycle is allowed things like our big Diamondback Athletic Syndicate. We built a large indoor gym for the youth of Midland. That was going through regardless.
Hmm.
We're building a hotel which is badly needed downtown. But
Think.
the investment has picked up, and I think the longevity of what we were going to be doing has allowed for people to allocate capital to a place like Midland versus in the past.
Yeah, that's really wonderful. Okay, last question. And this is a question that I ask all of our guests. And that is, what is one thing about your job or the oil and natural gas industry in general that would surprise most people in Washington?
Uh, I'm just making a guess here, but I would say that this industry and what we're doing is so much more technologically advanced than anybody thinks. We drill 2 miles down and 3 to 4 miles out, all within a 20-foot window in 6 days. And the level of engineering and ingenuity that goes into that, all of the little decisions to make that happen is pretty special. I think it's been interesting watching this intersection of energy and tech with the AI power boom. I can't tell Ann if it's going to make us cool or them not cool. We're going
Maybe
to
a
try
little
to
bit of
find a way
both.
to meet in the middle, because I do think there is a lot of tech going into our business day to day that's probably not understood.
Absolutely. I think Landman might actually be what's making your industry cool, but maybe tech will rub off on it a little bit too.
Landman has helped a lot. I'm very, very supportive of, obviously it's a little bit hyped up versus reality, but I always judge something by if my friends in California reach out to me about it
Yeah.
and about my job, and Landman is one of those moments that they've been reaching out to me about. So that must mean it's a hit show.
Indeed, indeed. I've been surprised by the questions and reactions I gotten from it as well. Case, thank you so much for being with us today. I know that you've got a lot on your plate, and this was incredibly informative, and I really appreciate you taking the time to share your perspective. So thank you so much.
Thank you.
Thank you for joining us here for another episode of Longer Laterals, where America's energy story meets Washington. We'll see you back here next time. Thanks for joining us.